Friday the 5th. Good morning. Guy Johnson, Tom Mackenzie, Valerie Tytel on deck this morning. We've got a lot to talk about. We're an hour away for the opening trade. So what do you need to know? Of course, it's jobs day in the USA. Volatility falling, stocks rising as traders look for rate cut confirmation. Speaking of confirmation, Trump's economic advisor, Stephen Miron, looks on track to vote at the FOMC's September meeting. And Broadcom surges as it partners with OpenAI to take on Nvidia, Val.
Another positive day for the equity market after breaching all-time highs in the S&P 500 index on the Wall Street session. S&P futures and Eurostoxx futures both up by 0.25%. That bond rally is still continuing. U.S. 10-year yields at 4.15. 10-year yields are down 10 basis points now on the week. That bond route is clearly on the back burner. Euro dollar at 116.75. The dollar's really gone nowhere this week, but we are a bit softer when it comes to the dollar index. The countdown to the opening trade starts right now.
Friday morning, the day we've been waiting for. Payroll day is here. Is it going to confirm or deny the idea that the Fed should be cutting in September? So I've got so many things that I've kind of been thinking about around this topic, and we're going to debate this. I'm wondering, what is the number that changes the narrative? Does it have to be north of kind of 130K? Does it need to be less than 40? If you get a negative print, what does that do? Does that spook investors because we're maybe flirting with a recession? What is the... It strikes me as there's a kind of number of around 40 to about 100 and something, 120, 130. Within that window, nothing changes. And the volatility story that we're seeing on the screens at the moment is basically... right, we're not going to get much volatility around this data. What do you think?
Oh, well, look, it's still a big data print today. Clear your desk for 1:30 p.m. London time. 75K is the estimate, but you're right. There is a lot of chat out there that there's really nothing that this non-farm payroll print can do to dent the September rate cut. But what it could do is dent where the terminal rate has fallen to. We hit cycle lows for the terminal rate in yesterday's session. 150 basis points of easing is priced in now through 2026. You can thank the week labor market data we've had this week, be it JOLTS, ADP, jobless claims, really set the bar for more Fed cuts.
So Val's in the kind of bad news is good news camp. I'm not there yet.
150 basis points by the end of 2026 completely overlooks the inflation concerns. And we have CPI next week, and we have warnings from others that inflation rears its head. How do you get 150 basis points?
Because Stephen Miron's telling us that this is deflationary. All of this stuff is deflationary. All the Trump's policies are deflationary. You've got to have a slower economy for it to be deflationary, but it's deflationary, so that's okay.
But look, a 75K print today, that is the lowest consensus estimate that we've had since December 2020. You take out COVID, you have to go all the way back to 2011 to find a lower consensus estimate.
But the labour market has changed, hasn't it?
Look, that is definitely one argument that we are at a lower run rate for the U.S. labor market because of things like immigration. But the other thing that will be a focus is revisions. Remember, this is the first print of NFP with the new BLS chief at the helm.
No, he's not at the helm yet. He's not there yet. He doesn't take over for a little while yet, so you've got an interim person in place at the moment.
With the previous one not there, shall I say, different management in place. We had the biggest revisions last time that were the biggest in 4 decades. Revisions could be something that could change the narrative as well.
So are we looking at data sets that are politicized as well as the Fed? Because that is going to be a concern as well. Guy, just going back to your point, and we'll get on to Myron's hearings shortly, but you talked about the different scenarios, plus 120, plus 130. Is that where you get to a 50 basis point cut from the Fed? Does that spell panic? And if you get sub 75, so this will be the 4th straight month where you get sub 100,000, according to the estimates. If you're down at negative, and that's one scenario you outlined, if we get negative, then are we actually set for a stagflationary scenario for this US economy in terms of falling jobs, higher inflation, and what does that mean for pricing beyond September?
And how does that change the bond market story? Does that take long-dated bonds north of 5%? Because I'm trying to figure out what gets equity markets lower at this point, and it's a real struggle, to be honest. You wonder at any point in the economic cycle, do equities actually go lower? The answer appears to be at this point, no, judging by market pricing. You wonder whether or not kind of history would speak to a maybe slightly different outcome. at some point. Like at some point, they've got to go lower, right?
Well, look, you could definitely argue that if we get into a tricky state of Fed independence, if we have inflation rising and still this pressure on the Fed to cut interest rates, it's definitely a scenario where we have bond market puke in the back end, and equity markets wouldn't like that. We've got kind of some hints of it today, or yesterday, in the Senate confirmation hearing of Stephen Myron, the Trump's next pick for the Fed governor seat.
So here we have. Is he independent? Is he not independent? This was kind of the debate yesterday. So it looks like he's on track. Looks like the chances are he's probably going to be voting by September. That seems to be the trajectory that we're on at the moment. I think the key question, therefore, is he independent? Can you, as a member of the White House team, go to the Fed and be independent and then come back? Does that, because if you don't vote for a rate cut, presumably you don't get to come back. Is that would Trump open you with open arms if you haven't voted for a rate cut at the September meeting? Does that kind of slightly undermine maybe your independence?
The way that Trump operates suggests that the answer to that question would be no.
I think we all know the answer to that
That's where
question,
the criticism lay from the Democrats when it comes to Myron in his testimony, was that he had written about the revolving door between the White House and the Fed, and now he is, at least on some conjectures, part of that revolving door, because he comes back to his job at the end of it. He's also written that 2024 report as well, outlining some measures he would like to see, changes to the Fed, that on many measures and many readings would undermine, at least to some extent, Fed independence. And that was part of the rationale for that report of 2024.
Yeah, well, he did face a lot of heat on Democrats, but in his defense, he said that was something his lawyers advised, was to take a leave of absence, and then if he is then confirmed for a full term, full 14-year term, he would then resign from his seat at the NEC.
Basically, I think this is the way we get around this, is basically he's only going for a few months. He's basically a temporary. He's like a sort of super sub coming on for a little while.
We'll see. Some can definitely argue that we're underpricing him as a potential Fed chair candidate.
So that's what I was going to get onto, is that if you look at the betting odds, the chances of him becoming the next Fed chair are starting to pick up the pace. So that, and I think that's the more interesting debate here, is this guy the next Fed chair? And if he is, what does that imply for long-term interest rates, and therefore what happens with the bond market? I think that increase. This is a sideshow. What he does in September and kind of what happens around that. The longer-term picture is this the guy?
How much of the 1 to 1.5% growth that we're seeing in the US right now is coming down to data center build and infrastructure? Because we had the updates in terms of the chip competition coming through from Broadcom. It's not a huge surprise. We know that the hyperscalers themselves, the likes of Meta, the likes of Amazon, the likes of Google, are building out their own AI accelerators to try to reduce their dependence on Nvidia. But the announcement that there's potentially a $10 billion order from OpenAI partnering with Broadcom, to be clear, OpenAI would be designing these chips and Broadcom would be producing them for them. It was a partnership. Reminds us there is competition when it comes to Nvidia, even as it has that 90% market share. Now, this is a different part of the chip ecosystem, and Broadcom is very much focused on the networking and specifically designed and customizable chips. But it's significant.
So I was thinking about this, and I'm trying to work out, is this a zero-sum game? If you assume that the overall AI pie doesn't change depending on kind of who builds what, if Nvidia loses ground even a little bit to Broadcom, does Nvidia's stock come down? Does Nvidia's stock drop? That could maybe dent the equity market.
Is that what you're trying to argue?
Is the stock drop in Nvidia compensated for by the rise in Broadcom, or is it a net negative because actually there's more competition, and as a result of which the margin story? I don't know, but it's kind of, in totality, is the AI story worth less if Broadcom does better?
No, I think that's a good point. More competition, these lucrative margins might decrease, and that's really a big part of Nvidia's valuation. But you have to also tie in that many of these tech leaders were at the White House yesterday.
That was amazing.
They were supposed to have dinner in the Rose Garden, but I think it rained, so the meeting was moved indoors. But Mark Zuckerberg was sitting right there on the left-hand side of the president.
Is Melania Trump the new AI czar? Has she taken that mantle now? Because she was convening this meeting.
Yeah, there was her meeting, and then they were just having dinner with the president afterwards. Everybody looked very happy there, didn't they?
They did.
They all looked very happy.
And they went around the table pledging all their commitments to the U.S.
Yeah, amazing. An amazing scene, you could argue. Andrew Sheets is going to be joining us very shortly. Morgan Stanley's Global Head of Corporate Credit. Seema Shah is going to be joining us later. Principal Asset Management's Chief Global Strategist. Freya Beamish is going to be joining us, and T.S. Lombard. She's the Chief Economist over there. All have interesting things, I think, to say about inflation.
And when it comes to the data, we do have the big one later today at 1:30 p.m. U.S. time. That's U.S. payroll, Nonfarm payroll report. Before that, though, we do have the third reading of second quarter GDP out from the euro area at 10 a.m. UK time. We also have the Canadian employment report. And later today, as reported by the Wall Street Journal, Fed chair interviews begin by Treasury Secretary Scott Bessent.
OK, here's some more of what you need to know. This Friday morning, then, billionaire designer Giorgio Armani has died at the age of 91. Armani established his namesake brand in 1975 and created a retail empire selling everything from jackets to sunglasses and shoes, and became a cultural phenomenon. The Italian patriarch entrusted the future of Giorgio Armani to close family members and associates who will map the next steps for the company. And within the last few minutes, Denmark's Orsted has cut its EBITDA forecast for the full year, blaming lower wind speeds across its portfolio. Yesterday, a wind farm backed by the company and 2 US states said they are suing the Trump administration over an almost finished offshore project that was abruptly blocked by the government last month. Connecticut's Attorney General blasted what he described as President Trump's all-out war on wind power. And French Prime Minister François Bayrou said he does not regret calling a confidence vote, putting his government on the line. In an interview on France 2 TV last night, Bayrou has argued the plan is essential to narrowing France's 2026 budget deficit. Opposition parties holding a combined majority of seats in the National Assembly have said that they plan to vote against the motion, which would force Bayrou to resign.
Okay.
So he's there defending again this decision.
French
bond markets, the French bonds have behaved relatively calmly.
Yeah. Well, they like what Bayrou is saying, and the sad thing is that he just doesn't have a lot of support behind it.
We'll see how he feels about that confidence vote Tuesday. Anyway, we'll come on to that a little bit later on. Coming up, European leaders forging ahead with pledges to provide Ukraine with security guarantees, but commitments from the US appear to stall. We're going to bring you the latest on all of this. Plus, keep an eye on European ship stocks at the open. Broadcom giving an upbeat forecast. We've just talked about this. AI demand apparently remains strong, but Trump is talking about chip tariffs, so we'll fold that in as well. Up next, we return to the big story of the day. Jobs Day in the USA. Andrew Sheets, Morgan Stanley's global head of corporate credit research, is going to be joining us. I urge you to join the debate as well. IB plus... The little gizmo is going to appear. It'll show you how to do this. BBTV Go on your Bloomberg. That's the function. Get in touch. We'd love to hear from you. It's Friday. This is Bloomberg.
We are a little under 45 minutes then from the opening trade as we count down, of course, to the non-farm payrolls jobs data out of the US. We're risk on across the equity markets, with European futures pointing to a third straight day of gains. US futures also up. Val, what are you watching for?
Look, it's all down to the jobs figures today. Will we get a print weak enough to keep this equity rally on track? The consensus estimate is for 75K. That is above the prior reading of 73K. But watch out for those revisions. That's really what grabbed the market's attention in the previous print. The steepest revisions downward in over 4 decades. We get the same kind of feeling from this print today. Also, watch out for that unemployment rate. It's expected to tick up to 4.3%. Remember, the balance between dropping labor supply and labor demand is really in focus for the Federal Reserve. But markets are nervous heading into this print. It's what sparked this big bond rally this week after starting Monday and Tuesday with a bond rout. We've had a string of weak data, starting with the JOLTS miss, ADP, the run rate of ADP, half that of the prior month, and then initial jobless claims continue to creep up week on week. It has led this bond rally to continue. Those 2-year yields are at year-to-date lows, and the terminal rate for the Federal Reserve now is at cycle lows as well, with 150 basis points of easing priced to 2026. It's led this equity market rally to perform very well yesterday. We had one of the first all-time highs in 5 sessions for the S&P 500, now up over 10.5 on the year. Guy.
Equity markets are record highs. Credits at super tights. The US economy is apparently slowing. Okay. Park that one for the moment. Andrew Sheets, global head of corporate credit research at Morgan Stanley, joining me around the table. That's it, isn't it? This is weird. You've got markets signalling that everything is great, and yet apparently we've got a US economy that's slowing down and the labour market is in danger of falling off a cliff. Something doesn't feel right to me.
Yeah, I think this is a real fascinating day, a real fascinating number, because it does feel like the market is walking a really fine economic path, right? And right, there is this story of maybe the market wants weaker data, maybe weaker data is the thing that will drive more rate cuts, but gosh, the market history of getting a negative payroll number and forward-looking 6 or 12-month returns, very bad. At the same time, if you get those stronger economic numbers that take that recessionary scenario off the table or lower that probability, you've got a lot of cuts priced in already. That becomes a little bit more awkward as well for all these discussions around the Fed's independence and next moves. So, look, we're forecasting 75,000, kind of right bang in the middle. That I think could be fine, but it's a narrow path.
What is credit signaling right now about what's happening in the U.S. economy?
So I think credit is signaling that recession risk is low. I think it's also signaling that corporates are in a relatively better trajectory than sovereigns. If we look at relative levels of issuance, if we look at relative ratings trends, corporates have an advantage. And I think investors...
corporate credit is better than govy credit?
Well, in terms of the outright level, maybe not. But in terms of the direction of their fundamentals, it's looking a little bit better. And I think that's helpful. I think this is a market that's trying to avoid stories or avoid uncertainty. And so you've had more uncertainty, say, in the mortgage market or in the sovereign market. Credit's been a little bit cleaner.
On a regional basis, how does that break down then? Because the earnings story has been very different. Certainly the earnings projections looking forward for European corporates versus their US counterparts is a very, very different picture. It's more challenged. What is the read across to the credit space?
Yeah, so this is actually where our view at Morgan Stanley between equities and credit is a little bit different. So for the equity side, we are more positive on the U.S. We think that earnings story is better, and we think the dollar continues to weaken. That's a big tailwind. Maybe it's cheating a little bit, but that's a big tailwind to S&P 500 earnings. For credit, because the sector mix is a little bit different, because it's a little bit more financial heavy, it's more utility heavy, it's more telecom heavy, those sector differences are a little bit less pronounced in our view in corporate credit. And so our forecasts for the two regions are a lot more similar. It's Asia where we're most cautious. I think that's a market, it's a smaller market, but where credit is very tight relative to still what we think are some pretty significant trade risks.
So are you getting, is there any complacency priced in, given that spreads are narrow in historical comparisons? Is there complacency at this point in the credit markets anywhere?
I think it's a funny market because at one level the answer to that is obviously less, right? Obviously, yes. We're at 20-year lows in corporate credit. There are low levels of risk premiums, and yet I think this is a market it's not buying everything. If you look at credits that get downgraded, if you look at credits that miss earnings or get downgraded certainly to say CCC, the penalty for that in the credit market has been enormous. And so this is a market that's still not willing to buy everything. I think if it's a clean credit story, if people feel comfortable, it can trade very tight. But there is still there's still that penalty for things that have a little bit of hair on it.
Andrew, just walk us through a scenario where if we do get this bond route that everyone is worried about, Treasury yields go above 5% again, what is the reaction in corporate credit? Do they rise in tandem just with fixed income selling off, or do they get some sort of risk-off safe haven bid? How would corporate credit react if we get some real deficit concerns coming back again? Yeah,
so I think this is an area where our view maybe differs a little bit from others or how it's sometimes portrayed. I think higher yields is the better scenario for us. If I think about what is driving credit spreads, what's causing them to be so tight, another big factor is just the buyer is a yield buyer. They're buying it because they like the yield. They're maybe not even aware of where the spread is. And so that is a function, that can drive very tight spreads. And if yields move higher, you get even more of that. What worries me is the scenario where yields go 50 basis points lower, 75 basis points lower, which is probably happening as well as data is disappointing. And that's kind of a double whammy. Then that yield-based buyer is a little less strong, and then the economic risk that credit should have to discount is a little bit worse.
It's a really interesting dynamic you're pointing out there. It just seems like in that scenario that credit really isn't the canary in the coal mine of the next recession.
Yeah, I think we're not the problem this time. I'm happy to report. And, again, I think, Guy, going back to your point, I don't think the credit market is signaling any recession risk that other markets aren't. I know the credit market has this reputation of being this early canary in the coal mine. I don't think we're seeing that. I think credit's been more cautious this cycle and in the aftermath of COVID. And so it's probably other factors that we need to look for to watch that excess.
Can I just get your view on Europe at the moment? German data out this morning, factory orders really bad. Unemployment in Germany beginning to creep higher. The UK kind of is muddling through, got a big budget coming up. We've seen, obviously, gyrations in what is happening in the bond market. What is the credit signal out of Europe? And is it different to what we're seeing out of the United States?
So to be honest, at the moment, it's pretty similar. And I think it's similar for some similar reasons. I think in Europe as well, the buyer base is a yield-based buyer. Right. European investment grade at 3% is still higher than it's been for most of the last 10, 15 years. That's still attracting money. European corporates have still been relatively conservative. And again, I think a really fascinating dynamic, because here we are with incredibly easy financial conditions, tight credit spreads, strong equity markets, and, M&A activity has been very low.
Yeah.
Now, it's been rising. It's been rising in Europe. It's been rising in the U.S. But, again, in both the U.S. and Europe, you haven't seen really yet the type of corporate hubris, aggressiveness that generally poses a problem. So I think in that way, things are more similar. But again, I think we have to watch the data, because even with all these strong technicals and market dynamics, when the market has made contact with real growth weakness or real growth scares, August of last year, the Liberation Day, we've gone wider.
When we zero in on France and the political risk that is emanating there with this crucial vote, of course, next week, what is the read across to the credit space? When we watch the equity markets on the back of that news initially, there's a lot of pain that comes through for French banks, for example. Is credit vulnerable to the political risk in France? Is it priced in? Does it start to get priced in? And under what scenario does it become vulnerable?
So I think in an odd way, I think there's a scenario where credit's a bit of a beneficiary on the investment grade side, as investors say, look, this is a large market with greater uncertainty, greater headline risk around it. Can I find something else that's safe, that just is, I can sleep a little bit better at night? And a lot of investment grade bond buyers, they're risk averse. They're not looking to be heroes. They're looking for something that's safe and a little bit boring. So I think in situations of kind of modest levels of political uncertainty, ironically, that can be good. Now, if this drives a much larger economic contraction in France, if this drives a much larger kind of policy shift, that could be a much bigger issue. But I think in terms of what we're seeing now is still broadly okay for the credit backdrop.
Andrew, September is known as such a ginormous month for bond issuance. We saw it here in Europe. They broke records for the amount of bonds issued in Tuesday's session. In your mind, how has the supply been digested globally so far to start the month?
So I think so far so good. I mean, you're absolutely right. September is this unique month. It's a weak seasonal month for credit and for equities, and in part because of so much issuance that gets done. But what our desk saw in the U.S., over the last, yesterday, the day before, was really strong issuance, but still net buying in addition to that in the secondary market, which is kind of suggestive, I think, that investors have cash to put to work, that there is demand there. So I think so far so good, but still early days.
Just to conclude, and just to make sure I've got this all right, bad news is bad news, right? So
I think so.
Okay.
Yes, I think so.
Wanted to...
I have that crazy opinion, but I think so, yeah.
Nice to see you.
Nice to see you too.
Bye. Andrew Sheets, Global Head of Corporate Credit Research at Morgan Stanley. What do we got coming up?
European leaders pledging to provide Ukraine with security guarantees as allies wait for the US to cement commitments. Details on that story next. This is Bloomberg.
I'm not entirely sure I care that much about what futures are signalling this morning. The world's going to change at lunchtime here in Europe. We're going to see what happens with the US payroll picture. Until then, everybody's just really, to be honest, holding their breath. The signal there is French stocks are up a little bit. Does it continue? This is more yesterday's rally than what happens for the rest of the day.
U.S. equity markets are adding to all-time highs. S&P futures in the green, European futures in the green. We got the bond rally continuing as well. Let's flip the board and check out how European fixed income is faring. We're seeing 1 basis point lower on German 10-year yields. It was a hairy start to the week, but we are 5 basis points lower on that German 10-year yield. It seemed like all this bond supply of September was absorbed quite well to start the month.
OK, let's get to the geopolitics then. European leaders pledging to provide security guarantees for Ukraine if a ceasefire takes hold, with 26 countries prepared to contribute, including troops. Meanwhile, the US is planning to cut funding for programs meant to help train and equip the armies of European countries that border Russia. Our Europe correspondent, Oliver Crook, has the latest. Ollie, let's start what we've been hearing from President Macron in terms of the details around some of these security commitments and how much progress has actually been made.
Yeah, Tom, we should say that to begin here that there is still a lot of ambiguity. There's still a lot to be worked out. These are, of course, very sort of complex issues, and it requires a lot of domestic buy-in. But we did get the sort of ball moved a little bit forward in the conversations in Paris yesterday with the Coalition of the Willing, which is now numbered in 35 nations strong. There's two main pillars to that. The first is the sort of precondition that any kind of agreement for the Ukrainians would not impose on their ability to develop their military, that there will be no conditions on the format and the capacity, the size of the Ukrainian military, and then apparently some firm commitments on how to regenerate and sort of resupply and help train the Ukrainian military. The second pillar, and this is of course the most crucial part, is this idea of the reassurance force. What we got yesterday from Emmanuel Macron is apparently there is now a firm commitment from 26 of those 35 nations, and other ones are still thinking about it, to commit troops in some capacity to be the reassurance force within Ukraine. He made very clear that these are not really to be combat troops. They are not going to be on the front line. They are people that would support the Ukrainian military on the soil, in the sky, in the sea. And of course, this is something that they would potentially put there in the event of a ceasefire and a peace agreement, right? We also got from them, they had a call with Donald Trump in the afternoon after that sort of meeting, and we're still waiting in the next few days that apparently the United States will finalize what their commitment would be to the security guarantees. We do not know what that looks like. We've reported on in the past that could be in the form of intelligence, hardware, potentially air support, but obviously not troops, since Trump has made it very clear that that is sort of a non-starter. That being said, on all of this, two major footnotes. This is a meeting that is chaired by Keir Starmer and Emmanuel Macron, two very sort of politically weak leaders within their own country, and two economies that are fiscally strapped. How are they going to pay for all of this? And of course, let's not lose sight of the fact that this is all planning for the day after. We're still very much in the day of in the war in Ukraine.
Yeah, good point you make there about who is going to foot the bill for all of this support for Ukraine. But what's the next step when it comes to sanctions on Russia?
So what the Europeans are hoping is that Donald Trump will make good on the full pledge to eventually put on secondary sanctions for all of those other nations that are still buying Russian crude and gas. He's basically, yesterday, Trump, or a few days ago, mentioned that the first step of that was actually the sanctions on India. That is seen as the first step of the secondary sanctions, that 50% tariff that exists on India for buying Russian crude, that could accelerate in the next few days. But again, all of this planning for the day after is irrelevant if Putin cannot be driven to the table with Zelensky and the trilateral meeting, and so there are more efforts continuously to try to get him to the table, and the Europeans have more or less maxed out what they can do. So what they're hoping is to be able to join the U.S. on secondary sanctions. That is going to be potentially the next step, but that will rely on what Donald Trump basically thinks about Putin's intentions. That being said, there's also another sort of interesting nugget from this conversation. We heard from the Finnish president, Alexander Stubb, after this meeting that apparently on the call, Trump is trying to put the Europeans more pressure to basically stop buying all Russian oil and gas. And another thing that was sort of interesting is he wants to put more pressure on the Europeans to try to put more pressure on China, which is very interesting to hear officially the sort of Trump administration trying to get the Europeans to work collectively with the U.S., who's been going very much on a sort of America first, we do our own policy to try to coordinate a little bit more. I wonder how much of that has to do with that military parade and the geopolitical developments we've seen over the last few days in China, whether it's Putin, holding hands with Modi, embracing Kim Jong-un, and that really sort of awesome show of force by the Chinese on the streets of Beijing.
Okay, Ollie, it's fascinating, actually. Vladimir Putin is talking about this very issue right now, talking about the fact that the gas formula for supplying China through this new pipeline will be market-based. I'm not entirely sure what that means, and I'm pretty sure that China is going to be getting a cheaper price than the global market, which in theory should lower the global market for LNG as well, because the Chinese won't be absorbing that gas. But that honestly, he's speaking about this subject right now and talking about some of the details surrounding that deal that has been done with China. Ollie Crook, thank you very much indeed. He's speaking at just for notes, at an event in Vladivostok right now.
Well, switching topics, the Danish central bank governor expects U.S. tariffs to shave about 0.5 percentage point off the country's GDP. Christian Kettle Thompson sat down with Bloomberg's San Was at the bank's HQ in Copenhagen for an exclusive interview. They discussed the impact of 15% levies on Denmark and the wider European economy.
I think first of all, it means that, and I heard that from business leaders, that it takes some of the uncertainty away, sort of this cloud of uncertainty that has been sort of in the horizons since the beginning of the year. But of course, also it means that there will be less direct exports to the U.S. from Denmark, from Europe, in the coming years. More specifically, we believe that the sort of the isolated effects of this of these tariffs will be in the size around 0.5% of GDP in growth terms, compared to what growth would have been if tariffs had not been there, and that would sort of it's both sort of direct effects. How much less exports are there from Denmark to the U.S. In goods, but also some more indirect effects from when other countries, they export less to the U.S. because of the tariffs. Then there will also be lower growth there and lower Danish exports. But sort of overall, roughly around 0.5% of GDP would be the impact.
How should European policymakers respond to this?
In Denmark, we have a saying, an old saying, that what is outwardly lost, you should regain inwardly. And it comes from Denmark's tradition of giving up land abroad and to become the Denmark geographically that we are today. But it means that, okay, how to go about this? And of course, I think we should always try to convince the U.S. about the benefits to all partners when we're talking about trade and to reduce that. But I think also, or I not only think, but we have here in the bank, we made some analysis looking into how much do the barriers to trade in intra-EU, within the EU countries, how much do they sort of hinder trade? And that's quite significant. If we compare to the barriers to trade between the provinces in Canada and also between the states in the US. Canada is maybe a little bit more sort of the region to compare to, because they resemble us in many ways. And if we look at that, then you could see that even if barriers to trade between the provinces in Canada are quite large, then they are much larger in the EU. And our analysis suggests or indicates that also only modest sort of improvements, that means modest reductions in the internal barriers to trade within the EU, can actually offset the negative impact from the US tariffs. This is easier said than done. Because it's many smaller things you have to do, and it's rules, regulations, and customs and stuff like this, and not sort of big political initiative, so to speak, but more a long-term pull to do these things. But basically, this is what the internal market is about, and it seems that they have lost a little bit momentum in this respect.
Danish Central Bank Governor Christian Kjetil Thomsen speaking there to Bloomberg. In that conversation, the governor also discussed the impact of Novo Nordisk's recent weakness on the economy. He expects the central bank will cut its economic outlook for 2025 substantially because of Novo's weaker sales growth and US tariffs. So tariffs in impact. Novo Nordisk stock down about 60% in the last 12 months. And of course, it has this outsized role in the Danish economy, the broader pharma space as well. They employ about 30,000 people just at Novo.
So you've got Novo and you've got Orsted, you've got the whole wind story kind of that's ripping through this economy. But it's interesting, actually, you talked about the fact that it's not the outcome, it probably isn't as bad as actually the finance ministry is predicting. So he's actually taking a slightly more sort of sanguine and positive view. But it does seem as if the corporate narrative is having a very big impact in what is a relatively small country at the moment. Two really big outside kind of stock stories really manifesting themselves in a big way.
It was expected to be one of the fastest growing, if not the fastest, the second fastest growing economy in Europe after Malta, Denmark. And then, of course, the downgrades on the tariff and the corporate impact. To your point, Vestas is down in the last 12 months. Orsted is down about 50% in the last 12 months. And Novo down around 60%. And growth apparently would have halved in 2024 had it not been for Novo. Novo now facing that increased competition and some of those copycat drugs in the weight loss space. Now, a note. Bloomberg is hosting a live Q&A, talking of Novo, on Novo Nordisk this afternoon. The blockbuster success, of course, of Ozempic and Wegovy, making Novo seem unstoppable up until recently. But now the drug maker faces, of course, that host of challenges that we've been referencing. Our reporters will be answering your questions from 1 p.m. London time this afternoon. Just go to Bloomberg.com.
Well, still ahead on Bloomberg TV, another Swiss company is shaking up its top leadership this week. The CEO of Temenos is stepping down as the Swiss executive carousel goes on. We'll talk about that and your other stocks to watch next. This is Bloomberg.
We are 15 minutes from the opening trade. Risk on across these equity markets. It's been a solid session over in Asia. European futures pointing to gains of 0.3%. US futures as well on the S&P EMEs after a fresh record yesterday above 6,500. Currently looking to build on that, pointing higher by 0.2%. If Guy Johnson isn't excited about these futures, I am, Val.
There we go. Share in the enthusiasm, adding to record highs in the U.S. equity market as we speak. Well, staying with central bank policy, President Trump's pick for the Federal Reserve Board of Governors has pushed back against Democratic concerns that he would do Trump's bidding at the central bank. At his confirmation hearing before the Senate, Stephen Myron affirmed his commitment to Fed independence and pledged to make decisions based on his own analysis. But there were concerns about Myron's decision to keep his White House job while at the Fed.
I have received advice from counsel that what is required is an unpaid leave of absence from the Council of Economic Advisors. And so considering the term for which I'm being nominated is a little bit more than 4 months, that is what I will be taking. As long as that is the advice of counsel, I will follow the law.
Well, your independence has already been seriously compromised by your statement. You are going to be technically an employee of the President of the United States, but an independent member of the board of the Federal Reserve? That's ridiculous.
Myron also sparred with Democratic Senator Elizabeth Warren.
The Bureau of Labor Statistics data on various measures has deteriorated steadily in quality over time.
I understand that you may have questions about the data quality, but I want to remind you that when the data seemed to show that Donald Trump's jobs numbers were doing well, I didn't hear you say a single word about problems with data quality. The only time you started questioning data quality was when the numbers started showing that Trump's economy was headed in the wrong direction. So let me ask you the question for the third time. We want to understand your independence. Donald Trump stated that the BLS faked the job numbers before the election to try and boost Kamala's chances of victory. Do you agree with that, yes or no?
The Bureau of Labor Statistics did not take corrective action to improve the quality of steadily deteriorating data.
Do you agree with the statement that they faked numbers?
I believe that they were complacently allowing the data to continue.
Do you have any evidence that they faked numbers?
Well, as I said moments ago, the data have steadily deteriorated in quality, and I'm happy to give
in other words, just two straightforward questions about your independence, and you've blown both of them.
When you watch these things, you always wait for the Elizabeth Warren moment because it's always good and worth paying attention to. In some ways, the question is a relevant one. Can you take a leave of absence from a job at the White House with a political overlay and take a job at the Fed where you're meant to have no political overlay and be independent? I think the way that you square the circle on this is he's only going for a little while. And it's just a 4-month job. It's kind of a leave of... There is a kind of way of making this work. But I think it speaks to a wider story of this becomes the lightning rod for is the Fed independent anymore?
Well, and the next step is this. We're waiting for the Senate Banking Committee to prioritize the vote on his appointment and whether he'll be in that seat by September 17th, which is the next Fed decision. If he's there and Lisa Cook isn't, you really open up the bar to have a dovish, more of a dovish pivot. And
is that the objective? And this is kind of where the kind of the story develops is, are you in a position where we want to get you in for September so you can vote for a rate cut? And that again speaks to the lack of independence maybe for the fact that they want to put him
be
onto
clear,
the
President
board.
Trump is on record as saying we will soon have a majority at the Fed. And look, you can go back to those historical examples of other governments and other administrations putting pressure on the Fed, and that is true. But you can also point out the fact that this is unprecedented in terms of the level of pressure when you think about Lisa Cook, when you think about Myron, and when you think about the potential plans as well, according to Bloomberg reporting, around regional Fed governors, and that is something else that some of our guests have pointed to in terms of what to watch when it comes to the question of Fed independence.
Let's bring in Paul Dobson into the conversation, our Asia markets editor. Paul, let's talk about the data. These guys think it's funny that I think we can ignore the futures this morning. How much is going to change? What is the potential for the payroll number later on today to change where we are with equities, to change where we are with markets? How big a miss or a hit do we have, positive or negative, to change the current trajectory?
Yeah, good morning, Guy. I'm with you. I'm not really that bothered about this payrolls number because for me it seems like most of the Fed board has already made up their mind that they want to cut interest rates, and that's what the market's pricing in with near certainty, right? So a move this month is, 90% plus priced in, 2 moves this year, lowering interest rates as well. I think, it would need to be a pretty massive upset, a very big upside surprise for the Fed to defer that cut since, so far we have not seen pushback, especially from Jerome Powell. Now, there's still time for him to do that, so I could be completely wrong and it could get upended. But I think that all the labour market data that we have seen since that payrolls revision this time last month has been pointing in the same direction, and that is a slowdown but not a crash, a slowdown that allows the Fed to do a benevolent cut rather than a panicked cut. And that's why the equities market is so happy. Lower interest rates, all things being equal, if it's not a crash situation, should be juicing the economy, should be helping companies with earnings, should be pushing up their equity valuations.
Paul, we've been talking again about the question marks over Fed independence. How is that question being reflected on in your part of the world, given the global implications of Fed changes?
It's a really good question. It's really relevant as well. Asian investors hold a lot of treasuries, right, across the board from China and Japan, and also, large pension funds that are putting more money into it, particularly the likes of Australia. What we're hearing from them, we've spoken to some of the biggest investment managers about this in the last couple of weeks. The biggest one said, not a problem for me. I'm quite happy to continue putting my money in the US at the moment. Another one said, actually, this is a concern and we're scaling back a little bit on our treasuries buying. So the jury is a little bit out. People are definitely paying attention to this. I feel like, what we really need, personal view here, would be some big shock. And I don't think that's going to come today, tomorrow. I think it would be quite a long time down the line before it would be something that would be dramatic enough to alter the investment path on a global or an Asia-wide scale.
Paul, how are investors in your area out there in Asia dealing with this rocky week it's been in Chinese stocks? Can Chinese regulators really pull off this slow bull market, which they want to seem to engineer?
Yeah, that's the conundrum, right? If you believe that they're going to try and pull off a slow bull market, why wouldn't you buy the stocks today? And what we're seeing is another big rebound, even though through this week we've had news that they would really rather try to contain the pace of the gains in the equities market. Remember, the Chinese economy doesn't look great at the moment, but it's a little bit like we've seen in the US in recent years. There is no alternative, and the tech story looks pretty good. And so people have been taking their cash off the sidelines and putting it into the stock market, or pulling it out of bonds, putting it into stocks and plying in to that momentum trade. So the authorities would like to call it. They've got plenty of ammo if they want to do that. So there's going to be a little bit of a tussle coming up in the future from that.
Paul Dobson, our Asia Markets Executive Editor, thanks for your thoughts on the market. Now we have just 7 minutes to go until the start of cash equity trade. Let's get our stocks to watch with Chloe Melly. Chloe.
Good morning, Valerie. So let's start with Orsted, and Orsted really cannot catch a break. It just cut its profit outlook range this morning, and this, of course, comes after the capital raise that it announced earlier in August, which sent the shares really plunging and which shareholders are actually voting on later today. So we could see further weakness in those shares, that we can see that massive drop that we saw a little bit earlier in the summer. So this is really the big story to watch today. Moving on to Switzerland, where Temenos, the banking software provider, has replaced its CEO effective immediately. The CEO had been in place for a little over a year, so this really raises questions about the strategic direction of the company and the stability there. The shares have been doing quite well. We saw a spike earlier in the summer on the back of really good earnings, but we could see some weakness after that CEO replacement this morning. And finally, moving on to France, where Safran, the engine maker, is reportedly looking to potentially sell a large part of its aircraft interiors business. That is a smaller part, that's the smallest division, but it's still 11% of 2024 revenue, so not a negligible part of that company. So we could see maybe a little bit of movement in the shares this morning. Safran has been doing really, really well, and the shares are already up 45%, 46% this year. So also something to keep an eye on today.
Okay. Our equities reporter, Chloe Melly, thank you very much indeed with some of the stocks to watch, and we'll watch those, of course, at the open at 8 a.m. Deutsche Bank's note has dropped, and they say they're going to be watching the revisions when it comes to non-farm payrolls. Yeah. And they are framing this as the start of a really big set of weeks in terms of the data in the run-up to that decision from the Fed.
I just want to come back to the corporate earnings story as well. I keep an eye on defence stocks today. That's going to be interesting. Keep an eye on tech stocks today. I think there's an upgrade for ASML in the market too, so just pay attention to that one. The Friday session is about to begin. You could argue it starts at 1:30 when the data drops, but we'll talk about it between now and then. That's what the futures picture looks like. This is Bloomberg. Friday morning. How the session starts today may not be how the session finishes today. Feels like this morning's going to be about yesterday and the afternoon's going to be about, well, what the payroll data is going to tell us out of the United States. This is the picture from yesterday. US markets at record highs, pushing up towards the end of the session. Europe went out here, so we've got that to price in. And I think that's why Val's futures are pointing as positive as they are first thing this morning. Yeah, we're in the green across the board when it comes to that futures picture. Euro Stoxx 50 up 0.4%. The FTSE 100 also in the green. DAX futures up 0.4% as well. You're right, Guy. We do have to contend with payrolls, but it is a solid start to the session. Tom.
Some of the individual names to keep an eye on. Orsted coming through, of course, with a shareholder vote is going to be key in terms of that rights issue. So watch Orsted as they cut their outlook as well on earnings. Challenges around wind speed, but of course political challenges in terms of their projects over in the US as well. Temenos, that's a change of the CEO over in that Swiss company. So watch Temenos. And Safran, an FT report suggesting that the French company is looking to spin off maybe parts of its aircraft interiors unit, could be worth up to €1.5 billion. Guy.
Keep an eye on defence stocks. There's a lot of reporting around the fact that the US is looking to pull back. Does that mean that Europe is going to have to spend more? That could be a story to factor in as well this morning. Keep an eye on tech stocks too. We're going to be talking about what the Broadcom read across is. I think there's also an ASML upgrade in the market as well this morning to factor into your thinking too. So there's a lot going on as we await for payrolls. So let's talk about how we expect these markets to open this morning. We think it's going to be a positive story for equities. Equities are on the front foot. US equities were yesterday. We lead into the European session as a result of this on the front foot. How we finish the day remains to be seen. Volatility is really low going into this session, which is interesting as well. Anyway, time for the Friday session to get underway here in Europe. This is the picture you are contending with. It is going to be a positive one. The FTSE 100 is in the green, as is the IBEX already. We're expecting these markets to be up by 2, 3, 4 tenths of 1%. They're not big gains, but they are gains incrementally, just pushing a little bit higher. It feels like the bond market story from the beginning of the week is firmly in the rearview mirror, and we are looking forward to the data a little bit later on. So there you go. Stock 600, FTSE 100, IBEX all in the green this morning. I think we're going to see a similar story for the CAC. In fact, the CAC could be even more positive going into a weekend, obviously, of high politics in France. There you go, up by 0.3%. We'll wait for the DAX and the SMI to settle down. So quite disappointing data out of the German economy this morning. Just keep paying attention to those numbers because they're not great right now. That's the signal coming out of Germany. Anyway, what is the sector story? What is the single stock story? Val, what do you got?
Look, when it comes to the sectors picture, we are decently in the green. Only one in the red on my screen at the moment, and that is energy. At the top of the basket, basic resources, technology is up there. We also have autos and auto parts, and that's maybe down to this report, this German report that BMW is seeking a tariff side deal beyond the US-EU agreement. We are seeing shares of BMW in the green to start the session as well. But when it comes to the sectors, we are modestly, positively in the green. Only one sector in the red as I speak.
And you talked about tech. We've got ST Micro over in France, up 3.5%. ASML, a company the guy had flagged on the upgrade, coming through with gains currently of 2% for the maker of those lithography machines. Interestingly, that Stellantis is gaining as well, 1.8% in the auto space. But this is a tech story. And, of course, we had the Broadcom piece yesterday in that partnership with OpenAI on the production of those new chips. Just on the downside and clones of some of the individual names, you got a bit of softness coming through from Orsted, of course, a big day for them with that vote around the rights issue. Snoffy also low by 0.8%.
So it looks like the drug makers are where the weaknesses this morning in terms of the points drop. So you got Astra, Sanofi, Novo all dropping this morning, which I think is interesting. ASML, though, is the biggest points gain on the upside. So not only is the upgrade helping, but also I think probably the Broadcom story as well. Banks aren't having a bad morning. That's interesting in the light of what we've seen in terms of the bond market story earlier on this week. HSBC is having a good session. UBS is having a fairly good session as well. I think I might have seen an upgrade-downgrade story on UBS. I'll come back to that in just a moment. But it still feels like this is a marking time, waiting for the big number that's going to come through a little bit later on today.
Yeah, that's at 1:30 p.m. London time. Nonfarm payrolls report, big one for the direction of interest rates and the U.S. equity market as well. Joining us to discuss this is Seema Shah, Chief Global Strategist at Principal Asset Management. Thanks for joining us on this Payroll Friday. What's your call for today? Guy seems to think that there is not a lot of juice out there that can dent this equity market rally. Is there a print that could lead the equity market to end the session in the red?
Hey, thanks for having me on. Well, look, it's a fairly narrow path to continued upward moves. From here, if you were to get a significant negative print, let's say you're getting into a -50 or even like a low 25, I think there is potential that the market starts to really worry that actually the economic path is worse than expected. So I think the equity market may like it for the initial point, assuming that the Fed is going to cut rates a little bit more. But over time, that weakness is going to feed through. And equally, if you get a really, really strong print, but there's still a feeling that the Fed is going to cut rates whatever happens, I think you could see some movement at the long end of the bond yield curve, and then given valuation, that's a really vulnerable moment.
What kind of strong print is that? 130? Would it have to be above something like that in order to worry the bond market?
Yeah, I think the hurdle is fairly high to change this, to change the narrative. But certainly if you're getting above 150 to 175, which I have seen a couple of estimates suggesting that you could see a rebound, it's certainly not a central scenario. But I think if you were to see that point, and then the market doesn't change its pricing for what the Fed is going to do next month and beyond, then we start to get into a slightly dicey moment.
But at the moment, the view is that bad news is good news. I really struggle with this. The US economy is slowing down. The labour market is slowing down. But the Fed's going to cut, so that's great for equities.
I think historically, I mean, if you were to get Fed cuts into an economy which, fine, it's slowing, but it's not heading to recession, that typically has been really good news for equity markets. And I think that's what the market is saying, is that, look, yes, the economic data is weakening, but there's very, very few forecasts out there saying that recession is imminent. Yeah. So if you're going to now juice up the market with Fed cuts on top of that, well, look, we need to keep an eye on inflation. We need to keep an eye on a number of different things. Yeah. But that trajectory for the economy is actually fairly solid. And then for earnings, it's pretty good, too.
The market, again, are we OK post-Jackson Hole to ignore inflation? Like, is that the right thing to do right now?
No, and to be honest, I mean, I think that, look, at the moment, clearly the market is solely focused on the labour market. That is everything. But at some point, the focus has to turn back to inflation, particularly if and when you start to see some of those tariff impacts starting to feed through. Then I think the market could shift its focus. Yeah. But even from our forecast, we're only expecting inflation to rise to at most about a 3.5% level. And, you know, provided inflation expectations aren't creeping up with that, then I think, you know, you could be OK, as long as the Fed isn't cutting by 50 and you don't have these kind of 6, 7, 8 rate cuts priced in. So I think that's really key at the moment. But
that's where we are right now, isn't it? We've got lots of rate cuts. Waller's calling for lots of rate cuts. Myra's telling us it's going to be deflationary. We've got lots of rate cuts priced.
Well, the market is pricing in 6 cuts to the end of next year. Our own forecast is for 4 cuts. So give or take, we're talking another kind of 50 basis points. I think that's OK. It's really about the sizes, though. So if you were to talk about a 50 basis point cut next month, we start to hear more noise about that. To me, that really is a worry, because inflation hasn't disappeared. There still should be concerns. Yeah. And then you've already got that pressure at the long end. Everyone's keeping a really close eye. So it's, as I said, it's a narrow path to victory. But at the moment, at least for this month, I think things could be OK before that attention starts to shift back to other areas.
So, Seema, one scenario you mapped out was a kind of sub-25,000 on non-farm payrolls and showing real cracks in the labour market, panic, expectations of more cuts from the Fed. But, of course, there's that lag effect Which parts of the equity markets would be most vulnerable in that scenario?
Well, so I think it's going to be clearly the cyclical areas of the market. There's been in the last couple of weeks, a number of people talking about the consumer discretionary area, saying that that's really due for some upgrades. If you start to get labour market weakness, well, I think that throws that whole story into the bin. At that point, though, I do think that the market may start to look more favourably at tech again, simply as that's the kind of the safe island. Against a storm, where do we want to go? We want to look at balance sheet strength, cash flow, etc., and that points you back to tech. So actually, whichever way you look at the equity market as a whole could look okay. It's just underneath the surface. Beyond technology, things might start to look a bit more difficult.
So with the gravitational pull of tech, possibly one solution in that more challenged environment, what does that mean for the US versus European story in terms of equity flows?
So we still have a preference for the US over Europe at this point. Europe has had a great run this year, but we need to see more good news coming out from Europe. I think the catalysts are fading at this point.
Guy is very worried about Germany.
Yes.
And to be fair, you've been you started German data. You've been talking about the unemployment rate in Germany, and then the data confirming some slowdown there today. Is that how
the European story is premised on the idea that Germany's going to spend a load of money, the economy's going to take off,
so
and that's going to be
2026
great
story,
news.
is it?
That's not showing up in the data right now.
Right, and exactly. I mean, I think I would share some of that concern. I'm not expecting a very tough, at least a very negative year for Germany by any means. But I think that given how much the equity market has run up, you need to have a continuation of fairly solid economic data. You need to have evidence of the fiscal spending coming through, streaming into areas, showing up in the right areas, so not just defence, but showing up in infrastructure spending.
Yeah.
I think that's what investors are looking out for at this point. The good news is that the market is already assuming that the ECB isn't going to cut anymore.
Yeah.
So there isn't any, I guess, negative news on that front to come. That's already priced in. But it's really about the economic data. Where does that go? And where is that spending showing up? We need to see, almost like you need to show me the money at this point.
Yeah.
Are there any other risks on the horizon you think the market is underpricing? We focus on the labor market, we focus on the Fed. There's also the government shutdown that could potentially happen at the end of the month. Is that something you're worried about?
Not particularly. There's always a lot of noise around the government shutdown. We always see a little bit of market volatility, but traditionally, it's very rarely is that it's a sustained negative move for the market. So we tend to overlook or look beyond that. We'd certainly urge our clients to try and ignore a lot of that noise. We've already seen this year there's been so much noise around the government. This is, I think, is just another one of those factors. And it's really about focusing again on the fundamentals, what's really going on with earnings, what's going on with the Fed, what's going on with inflation. That's going to be the key track for the market.
And when it comes to the thought that Myron was sharing yesterday in his confirmation hearing, his stance is that Trump's policies taken together are deflationary. Do you agree with that? And if not, what's the one thing that stands out to you as an argument and why that's untrue?
I struggle to see how any of those policies are deflationary. I think the one deflationary, bright spot on the horizon is just going to be AI. What does that do? What does it do for productivity, etc.? That's not really down to Trump.
Immigration doesn't worry about being deflationary. There's a lot of arguments about the impact of the immigration policy on the U.S. economy, where it's going to show up, first, the labor market, economic growth. Is that something you're focused on?
We've been looking very, very closely at immigration, but the immigration story to us is actually a bit more inflationary, at least in the near term. Maybe in the long term, you start to have that longer-term negative impact on growth, and then it turns to be more deflationary, disinflationary. But certainly in the near term, the impact on wage growth, in some sectors, of course, it's not broad, it's not everywhere, but there'll be certain pockets of the market where you do start to see wage inflation coming through because of that restriction in labour supply. So again, and then you bring in tariffs. To me, if anything, we're worried about the upside to inflation, not really about inflation moving beyond or below the 2% level.
Given all of that, what did you make of the bond market turbulence earlier this week? Was it an opportunity? Did you buy the dip? Kind of how do you look at that as an event? Because in some ways it seems to have passed very quickly, and a lot of people are now sort of dismissing the fact that we had that it's a crisis. It just seemed like a little bit of a wobble, and we're kind of back to where we were. US rates are still really, at the front end, are still really low. That's great for the funding story over there. The UK is not really affected by what is happening at the 30. Was that a significant event? Can I take it as signal, or is it just noise?
It is not noise. That turbulence, I think, is going to come back. It's going to keep coming back. until there is some kind of resolution, either to the upside or to the downside.
What does that look like?
It looks really frightening.
Yeah.
I think the problem for the market and for everyone in this, which is why it keeps occasionally being dismissed and then coming back, is that nobody knows the timeline. Typically these bond market crises, they happen when they happen. So we know that there is a problem on the fiscal side. Everyone knows that. And that's not just a US story, it's a global story, which is why you've seen this move up in global bonds across the board. It's really, when does that start to hit?
When do you think?
I think at some point in the next 2 years, there's going to be a moment, there's going to be a crisis. Certainly from our fixed income side, we're really focusing on that short duration because we have got concerns about the long end. So we didn't buy that dip. We're trying to really focus on some of those areas which are less exposed to what we think could be a concerning moment. Now, I'm not going to sound the alarm bells, but it is something that we do need to keep a really close eye on.
Interesting that Ed Yardeni was saying that the US is still the best house in a crumbling neighbourhood. I mean, to your point about all these challenged economies, where do you sit? Do you agree with that line? You want to, if you do need exposure, do you
just move out of the neighbourhood, though? Do you just leave the neighbourhood and just ignore the whole thing?
No, I do. I mean, look, we know that the US has a problem, but it also has a ton of benefits, the main one being that people are going to continue to buy treasuries because it is that reserve currency. At the same time, the problem for the UK is more immediate. Yeah. You've got the France issues. The concerns that maybe that we have is that actually you could get some contagion. Let's say that the UK gets a little bit more worrying, you get closer to the budget, maybe the market responds in a really negative way to whatever Rachel Reeves is going to announce. Well, then the global bond story becomes a little bit more concerning.
So the UK could be the centre of a contagion risk, potentially?
Yeah, I think that there's always going to be that risk factor. The UK, to me, is the area which has got the most concerns from a fiscal side because it's very, very difficult for the Chancellor to get out of this mess. I'm not really sure what tax or spending cuts that they can do, tax rises, spending cuts, they can do to really change the narrative. So they are in a difficult spot. Now, of course, the US is quite different. But if you were to see this continued move up in gilt yields, well, I assume that there would be some kind of global impact, whether or not that means crisis. But I think that would probably add pressure to Treasury, certainly.
Structural reform, deregulation. It's going to see where she goes down that road. Seema, great to see you. Always a pleasure. Thank you very much indeed for coming to see us. Seema Shah, Chief Global Strategist at Principal Asset Management. European equities have rolled over a little bit. That's what the Core 6 looks like this morning. Few negatives, few positives. We've kind of, I think we've priced in the move yesterday afternoon in the States, and now we await what comes this afternoon in the US in the form of payroll data. So that's kind of where we are right now. Interesting to see defence stocks on the front foot, but the real story this morning is in the chip sector. ASML up very, very strongly. Let's talk about all the other details we're watching. Chloe Mellie's here with the details.
Good morning, guys. So yeah, let's start with the chip sector. So we've got some positive read across from Broadcom's partnership with OpenAI, and we can see that for ASML and STMicro. And for those two in particular, there's also been two new buy ratings. So ASML was raised to a buy at UBS, and STMicro was also raised to an outperform rating at BNPP Exane. So both of those things are two sets of really good news for that chip sector and those two particular names in that sector. So we have some green movements this morning in that space. Moving on to Orsted. Orsted is, as expected, down on the back of that outlook cut. It cut its profit outlook range this morning. This comes after some other bad news with, for example, Trump ordering it to stop work on a big wind project and the capital raise that had already sent the shares plunging earlier this summer. So another set of bad news for Orsted, and it is down a little bit this morning. Moving on to Temenos. Temenos has replaced its CEO effective immediately last night, and the market is reacting really badly to that. The shares are down 13%. It really raises questions about the stability, the direction of the company moving forward for that banking software provider. Moving on to Hexagon. Hexagon is a Swedish industrial company. It is up this morning on the back of selling its design and engineering unit to a US company called Cadence for 2.7 billion euros. So market reacting quite positively to that for Hexagon. And finally, let's end with Sixt, the rental car company. It is also up. It was initiated at a buy at UBS. It is up 5% on the back of that. UBS mentioned that the US market share gains were a particularly positive note there. So positive this morning for Sixt as well.
Chloe Mellie from our equity team, thank you very much indeed. Coming up, we're going to look at what is next for the luxury house Armani after billionaire founder Giorgio Armani dies at the age of 91. That is next. This is Bloomberg.
Friday morning, good morning. Welcome back. You're watching the opening trade. We are 19 minutes into the equity market session. The Stoxx 600 basically gapped higher first thing this morning, basically filling the gap with what we saw from the United States yesterday. We had to price in that arbitrage. We faded that. So we're basically kind of back to where we were coming out of yesterday's session into today. This is we await the payroll number a little bit later on. There is, though, an interesting story, though, this morning in the chip sector. ASML is definitely one of the strongest performance stocks that we've seen this morning. Broadcom looks like it's having a really solid session overnight. All of the AI tech people had a lovely dinner last night at the White House. Apparently it was raining. Yeah. They had to be inside. They couldn't be outside. Nice new rose garden, I hear.
They wanted to show off, the White House wanted to show off not just their AI plan and their proximity
and the
to the tech bros and girls, but also to the umbrellas and the new patio. I mean, everyone loves a new patio, right? And they won't have one in the White House. They weren't able to show it off, but they were able to show off Melania and the president alongside, as you can see, some of the key leaders when it comes to driving innovation technology in the US.
It's sort of hastily convened, doesn't it? Kind of, we've just come inside. It's you're having a barbecue. It's raining outside.
Nice little flowers on the table. Come on, guys.
That's not little. That's a lot of flowers.
So they went around the table and essentially pledged their commitments to the US. They thanked President Trump and his administration, and they committed again.
Polite. They were lauding him. They were like, it was being.
This is becoming a trend, isn't it? If you look at the cabinet meetings that they're having, that are remarkable in and of themselves. Slightly different setting, obviously, but they made the commitments. So Apple, for example, $600 billion worth of investments. You've got OpenAI, Sam Altman investing heavily, of course, in Stargate as well. So that is all was part of that dinner as well, and significant. As you say, bringing it back to what's happening in the tech session today, just some of the key names coming through in terms of the gains. ASML's been upgraded. Interestingly, UBS analysts saying that a lot of the bad news and the overhang from the China story for ASML is now priced in, so they've upgraded ASML on the back of that. You're getting some of their competitors and partners, ASM, BE Semiconductor and ST Micro in France as well, upgraded, or at least prices up, stocks up, partly linked to the upgrade you would assume around ASML. And then there's a Broadcom story as well.
Well, yeah, you have to add to that there was maybe one negative point out of that Trump meeting with tech leaders yesterday, in that Trump warned of more pain ahead for the chip industry during the dinner at the White House with top executives, especially when it comes to tariffs.
Chips and semiconductors, and we'll be putting tariffs on companies that aren't coming in. We'll be putting a tariff very shortly. You probably are hearing we'll be putting a fairly substantial tariff on, not that high, but fairly substantial tariff.
He did note when he was speaking about tariffs that Tim Cook is in pretty good shape, kind of foreshadowing what we've heard before, that Apple is going to get a big carve out in any of these tariff regulations.
So, but they're starting to produce, Tim Cook's starting to produce a lot of phones in India, isn't he? Those cause the problem going into, but maybe they don't go into the United States.
And this was a strategy that's built out prior to Trump coming back into office for the second time, which we need to reduce our exposure not just on the consumer in China, but also the supply chain in China. And so we'll start to build out factories and processing units in the Indian market, and we'll try to tap into that strong consumer as well in India. And that is starting to pay off, at least in terms of the numbers that Bloomberg has today, in terms of revenues rising about 13%. So they're getting about $9 billion. Now, in the scale of things, that's pretty small, but it's the trajectory of growth that's been very impressive in India for Apple. But at a time, of course, when we have these 50% tariffs on India, Apple is not impacted by that because they do have this carve-out, to your point, Val.
I feel I should have worn an Armani tie this morning. I didn't. It's a mistake. I wish I had.
We would like to see that, Guy.
Yeah.
You'd be
maybe
you
on
could be a better model for the Armani tie
on Monday
than Guy Johnson.
Anyway, the great man has died. Giorgio Armani dies at 91. He kept his empire together for decades after decades. Never had some sort of succession in place. He kept the helms of this business, which was absolutely amazing. Independent, it was always independent. Like Italian icons, Gucci and Fendi, they were snapped up by other names, which is so interesting given how Armani basically kept everything that he had together. The future of the empire that he created now in the hands of family and close associates. Flavio Rontandi joins us now from Rome to talk about all of this. Armani is just this amazing Italian character, this amazing Italian leader. He told Bloomberg News last year he wouldn't rule out an IPO or a sale to a larger group once he was gone, but he was waiting for that. Not he was waiting, but everybody was kind of knew that it wouldn't happen until that moment happened. What happens now? What's the company saying about what the future of this business looks like?
Armani also. What we got yesterday, what I got yesterday, for example, from the spokesperson of Mr. Armani was that now the future is somehow in the hands of the family, the heirs, and the Lorco, who has been his partner for years, his right arm for years. But this is, of course, a kind of a generic, if you want, answer. We don't know in details what is really going to happen. We know that there is a succession plan pretty precise in place with some shares, some part of the company to be given to some members of the family, nieces and nephew, and again the partners. But we don't know exactly the percentage. But also the main question is what happened next, because yes, there will be this legacy. This will probably be read next week, very soon, and we will have a better idea. But really, the big question is what will happen next, because as you mentioned, Mr. Armani last year in an interview with us told us for the first time that he was open to the possibility of an IPO, a possible sell of a stake, and he didn't mention groups, he didn't mention potential buyers, but the first time said this is something that we cannot rule out completely, because we have to adapt with the times, we adapt with the changes that we are facing, and we have to keep the company in mind, what is really good for the company in mind. That was definitely is a take, and we'll see what's going to happen. Of course, there had many speculation about possible buyers abroad, funds, but we don't know for sure yet.
Okay, uncertainty in terms of what happens to this business going forward. Bloomberg reporter Flavia Rotondi, at a time, of course, where the luxury sector broadly has been challenged by the slowdown, particularly in the consumer over in China. Coming up, we will talk tariffs, labour supply, the Fed, and much more with Freya Beamish, Chief Economist at TS Lombard. That is next. This is Bloomberg. This is the opening trade. We are 30 minutes into today's session. I don't want to give too much credit to Guy Johnson, but when he pointed out that his excitement, the lack of excitement around the European future story was baked in, well, I have to give it to him, because look, we paired some of the earlier gains. We're up just 0.1%. We're essentially flat on the DAX. We're flat on the CAC grunt, and the FTSE 100 is up just 0.1%. The S&P, of course, 500 closed in fresh record highs yesterday. It really is all about that non-farm payrolls, and you're not going to be putting big bets on until you get that number through. 1:30 p.m. UK time. Guy, you called it on the futures.
Yeah, it's going to be a game of two halves though today, isn't it? It's going to be a quiet first half and potentially quite a busy second half. 1:30 p.m. is when the US data drops. We'll wait for that moment, and potentially we're going to get some volatility. It's really interesting. On the day, volatility is super low going into this number a little bit later on. Stock 600 members up, down. Well, actually tells you that actually the bigger names are maybe on the downside today. You got 196 down, you got 388 to the upside. Tech is on the front foot. Volume is a little light, but volume has been feeling a little light for a few days now. Kind of August, yeah, I can accept that. Beginning of September, maybe we need to get things going a little bit. One area that we have focused on this week has been the gold story. It continues to power ahead. One of the biggest beneficiaries of that is Fresnillo. The mining stock is up again today, another fresh 52-week high. The stock is now up over 300% on a 52-week basis, and this stock continues to be one of the ways that you trade that gold narrative. If you don't want to buy something shiny and heavy right now, you can buy maybe some of this. But the stock hitting a 52-week high once again this morning, going into the payroll data. Fal, what do you got?
Here's what else you need to know this morning. Broadcom is helping OpenAI design and produce an AI accelerator from 2026, jumping into the lucrative sphere dominated by Nvidia. Sources say the two firms plan to ship the first chips in that lineup starting next year. German factory orders unexpectedly dropped by 2.9% from the previous month, driven by declines in large-scale orders. The weak report underscores the challenges faced by Europe's biggest economy as it tries to leave behind a prolonged downturn while grappling with higher U.S. tariffs and Russia's war in Ukraine. And finally, traders today bracing for today's unemployment report, which stands to solidify views on Fed policy and determine the near-term trajectory of interest rates. The consensus forecast for non-farm payrolls stands at 75,000 for August, which would mark the fourth straight month of job growth below 100,000. The unemployment rate is expected to tick up to 4.3%, the highest level since 2021. Tom?
And the drum roll leading up to today's jobless print, the non-farm payroll print, has been a softer labour market. Whether you look at JOLTS or, of course, jobless claims, the Challenger report, interestingly, as well, hiring plans falling to the weakest for any August on record. To your point, 75,000, Val, is what is expected. That is the median estimate, of course. And the question mark is, to what extent above or below that does that become either a problem or a catalyst for the markets when we think about pricing in a Fed for September the 17th.
Yeah, and that weak jobs data that you've mentioned, the jobs data we had gotten so far has really led this week to become all about a bond rally rather than a bond rout. If you look at even the terminal rate in the front end of what we've priced in for the Fed, lowest for the cycle, and those two-year yields today are hovering at year-to-date lows.
Has the data over the last couple of months, there been a head fake? You always get this concern that once you start to see the labour market rolling over, it accelerates to the downside. But if you take a look at the ISM data yesterday, the US economy looks like it's in okay shape. And maybe actually it was a head fake and people start hiring again, and actually the labour market starts to pick up again from here, which means that we maybe refocus our attention back on what is happening with the inflation picture. Anyway, it's going to be interesting to see what the number today is. The whisper number is 75k. The survey number is 75k. Interesting to see those two things aligned as well. Freya Beamish, Chief Economist at TS Lombard, joining us around the table. Good morning.
Good morning.
Is the labour market rolling over in the States?
I think what you just said is very interesting in the lead up there, in the sense that this is more like a sort of a freak weather event than data, the weak data over the course of the summer and potentially still today, given that the ADP was at 54. It's more like there's been a big shock, there's been a lot of uncertainty, and companies are sort of on hold rather than us being able to sort of turn to these labour market data and say that is an indication of reflexivity kicking in and we're about to sort of go towards recession or some form of slowdown. It's more like a sort of a liberation day, in a sense, was more like a sort of a freak weather event.
So Chris Waller saying we need therefore to cut quite a few times in order to make sure that we don't get kind of the traditional acceleration in downside moves in the labour market. That's not the right way of looking at it.
I think the risk there is that you start to get a recovery as firms start to feel a little bit more certain. The jobs data and the inflation data go hand in hand. So if you get more certainty and companies starting to hire again, then you'll also see a pickup in the pass-through rate of tariffs to inflation. And so those two things are going to start going in the hawkish direction at the same time. So you could end up with the Fed sort of overreacting to the weakness in the labour market, very focused on the labour market over the summer and at Jackson Hole, and maybe kind of cutting too much. And then the big question is going to be more on the equity side, how much of this is sort of like boom-led, demand-led inflation, and how much of it is more negative supply shock inflation because that is a real serious concern. So it's more obvious for the bond market that would turn out to be, oh gosh, actually terminal rate is too low for an independent Fed at least. We've got a little bit of ahead of ourselves. Whereas for the equity market, it'll be more open to question if they do get ahead and kind of cut, whether this is like an inflationary boom or whether it's just supply-driven, negative supply-driven inflation.
Yeah, Frey, to that point, you noted in your note that you think that August was peak dovishness for the Federal Reserve. But it does get complicated if you do have Trump picks being a majority of those Fed governors' seat next year. I mean, that could be something that could really hamper this view that you have that the labor market's going to reaccelerate, inflation's going to reaccelerate, and the Fed's going to have to pivot. How are you calculating that in right now?
So I think for the next into December, so say we do get ahead and we get the cut in September, and they've signaled pretty clearly that that's going to happen. We'd have to see a lot to change that at this moment in time. By the time we get to December, though, if the labour market has started to recover, and we should talk about what's the bar for recovery, because it's lower than it was, then come September, I think the calculus is still on sort sort of like independent, we're doing what we're trying to do to actually get to inflation. Looking longer term, you know, there's a very serious encroachment here, attempted encroachment onto the independence of the Fed. Now, the long end of the curve cares less about that than the short end of the curve, so that's one way that we can play it. You know, if they do end up cutting, going closer to that what is currently seen as the terminal rate, which is quite low in my opinion, then that is just going to show up in greater inflation, and that'll show up at the long end of the curve. If we get to a situation where there's even greater encroachment on independence and there's some effect to control the long end of the curve, then it just shows up in the dollar, and hopefully they don't go further than that.
Freya, you know, you're talking about the reacceleration and recovery in the U.S. job market, but surely there's going to be some out there that will just argue, well, the run rate for NFP is just way lower because of the immigration policy. How would you, I guess, in your mind, a recovery looks like what on the NFP?
Absolutely, and this is very different in terms of what an independent Fed would see as a recovery versus what the sort of equity market bulls might be looking for as a recovery. 100 was the reference point that everyone that you've used in your introduction, that everyone uses. But with demographic decline and some of the papers that were coming through at Jackson Hole, with immigration policy, NFP break-evens are really coming down quite significantly. So 54 in an ADP, that feels weak, but compared with what is the new break-even going to actually be in terms of like how hot how high is actually a hot number?
Yeah. What's the number on NFP?
Weak. So today?
Yeah, no. Okay. What's the break even? What's the
break even? So I would say it's probably come down to at most 80. If we think about ICE ICE detentions getting back to 1,200 per day, which was the June peak, I would pull that NFP break even rate down even further into the 60s. So 54 is actually not that weak in that context.
What does all of that mean for wage dynamics in the US?
Yeah, good question. So we've got potentially a labour market that is more easy to overheat, and then we've got a level shift in prices certainly, which is what everyone is focusing on as a result of the tariffs. But the secondary effect of the tariffs is probably not just the level shift in prices, but also in the rate of inflation, in the sense that tighter labour markets easier to overheat, and tariffs are sort of cordoning off domestic labour market bargaining power from the rest of the world. So domestic labour market tightness is more likely to feed into wage growth than it was over the course of the past several decades, going back to the 90s. And then on top of that, the marginal unit of labour is going to be the domestic unit labour costs, and therefore the relationship between unit labour cost growth and inflation has to go back to a 90s type of relationship, where the margins are actually paying more attention to the domestic labour cost than they were to the offshore.
So just projecting out to 2026, then, if we do get a less independent Fed and we get the reforms and the changes that President Trump is pushing for, and they don't walk back in terms of some of the market pricing, we get 6, 5, even 4, and then we have a reheated labour market. What does that US economy look like in 2026?
So this is a really important pivot in terms of markets at the moment are very focused on the jobs numbers. I think none of the Fed independent stuff really matters if you're in an environment where, oh gosh, there's a sort of a recession risk, or there's a slowdown. Where it starts to matter and where the sort of the attack on institutions starts to get priced into markets is if this inflation stuff starts to come through, because then you need the Fed to be independent. So this is an economy where we are going to see, I think, more supply side driven inflation, negative supply shock driven inflation. That's going to deteriorate the correlation between bonds and equities. There's going to be less negativity in that correlation there. That's going to make it more difficult for the government to issue debt, because actually in that environment, when you have a negative supply shock driven inflation system, there is a positive correlation between bond issuance and yields. And so a lot of things happen.
That's a this year story?
That's a sort of a 12-month story. I think we keep on seeing instances of those correlations changing when there's like big shocks. When we think there's going to be a big tariff shock, then you see the positive bond equity correlation and dollar selling off. When we see those types of shocks, there's been a few event studies now where we get a little bit of a feeling of that. But we can almost go back to the 80s and think about the situation in reverse. It took a long time for term premium to get priced down in the 80s after the 70s. 70s. Now we're sort of almost in the reverse situation to that, where there's a good reason to expect term premium really should be higher, which means that bond investors are not really being compensated for the risk at this stage.
On that note, can I just shift the spotlight to Europe for a moment? Germany. There was this argument for most of this year that Germany is about to spend a load of money, the economy is going to take off, we're going to see some more positive data. I'm not seeing that data yet. I'm looking at the factory orders this morning. I'm saying unemployment's starting to... Am I just too early in the view that the German economy is about to take off, or should I be concerned about the fact that unemployment's beginning to tick higher and the chemicals industry doesn't look good and the factory data doesn't look particularly solid?
Yeah, I think we're still in the old regime, really. So a lot of what we've talked about with the US, the spillover of that is that the German fiscal house is being put in order. I don't think we should ever have expected that to have come through before Q4.
Right.
We're now, to be honest, pushing that back into next year in terms of when the fiscal is actually going to hit the economy. And I think that turns the European story into a benign form of reflation, a demand-led form of reflation. So in the US, we've got greater risk of negative supply shock-driven inflation, bad for bonds and equities in
so I can ignore
Europe.
the data for now. It's coming. It's going to get better.
It's going to get better.
Okay.
Okay, two different types of inflation as well, Europe versus the US. Freya Beamish, Chief Economist at TS Lombard, brilliant breakdown of what to expect as well on a day when we lead up, of course, to the jobs data out of the US. Coming up to UK politics, Nigel Farage takes centre stage, working to keep his party in check as the populist party Reform UK kicks off its biggest conference yet. That's happening today. We're going to discuss all of that next. And this is Bloomberg.
Welcome back to the opening trade. We're 47 minutes into today's equity session here in Europe, and we are at session highs when it comes to Euro Stock 600 up 0.4%. Also adding to record highs as well over on Wall Street. S&P 500 futures up 0.2%.
OK, to UK politics now. Nigel Farage is seizing the spotlight, not for the first time, as Reform UK kicks off its biggest conference yet in Birmingham, fresh from meeting Donald Trump in Washington. The Populist Party's leader is riding high in the polls here domestically. He faces a test of keeping hard right supporters in check while appealing to mainstream voters. For more, we are joined by our London Bureau Chief, Ruth David, and what to expect, what to watch for from the conference from Reform, and whether or not there's going to be a big business lobby there or not. Executives in attendance, the FT suggests that maybe not from their reporting. What are you going to be watching for? I mean, Nigel Farage has just been sparring with lawmakers in the US. Now he's here with his own summit.
Sparring with lawmakers, but that photograph of him standing with President Trump, I mean, a photo speaks more than all of the reams of coverage, right? To have that kind of backing and to have that kind of support globally. We saw Tony Blair going to the US. We're seeing Nigel Farage. And the question is, where is Keir Starmer? And I know Donald Trump is coming to the UK later. But it definitely seems to be like Farage is riding on a high. And it's interesting because, you know, a former Conservative minister once said that the Conservatives did not lose the last election. The Conservatives lost the last election. Labour didn't win it. And you have to think that right now when you see what's happening with the Labour Party. So everybody's saying it doesn't seem like Reform has a lot of key policies in place, but there's so much discontent with the way Labour is running this country that people are flocking to Reform. Look at the number of members, 239,000 for a party that was set up in 2018.
Yeah.
12,000 descending.
Is Reform now the opposition party? Starmer's treating Reform like the opposition party. He's not treating the Conservatives like the opposition party. He's treating Reform and tailoring policy and worrying about kind of what Reform is doing and thinking about how he responds to it. Is Nigel Farage the leader of the opposition?
Well, if you would ask the Conservative Party, Jacob Rees-Mogg, Nadine Dorries, there's this steady stream of Conservative Party members and ex-members that are now leaving to join Reform and that are being highlighted. And it definitely feels like there is that momentum. I think the big question is, how does Farage translate that into them being seen as the effective party that can set policy and that also is not far right? Farage seems to keep making the case that his is not the far right party. But if you look at Zia Yusuf and the kind of abuse that he has been getting, you look at the fact that a member of the party had said, let's ban the burqa. You know, there are a lot of these far-right leanings. And the question is the UK electorate ready for such a leader?
Judging by the polling numbers at the moment, that's an interesting question to ask. And the data sending you a pretty clear answer. Ruth, thank you very much indeed. Ruth David, our London Bureau Chief. Let's talk about French politics now. French Prime Minister François Bayrou says he doesn't regret calling a confidence vote, putting his government on the line as France is burdened with debt, quote. This as the French President Emmanuel Macron says he will seek to avoid a snap election if Bayrou loses. Jean Dabat of Bloomberg Economics has been looking at the likely economic fallout that we could potentially be seeing next week. Good morning. What are the different scenarios for France over the next few days? We've got this kind of series of events that could take us to another prime minister, another election, a presidential election. What are they telling you about the level of uncertainty in France at the moment?
Good morning. So, yes, absolutely. I mean, the baseline is that France is facing a new political crisis. In our main scenario, we expect François Bayrou's government to collapse on Monday afternoon after the confidence vote at Parliament. And then we would expect President Macron to appoint a new prime minister that will try to lean toward the center-left of the political spectrum, and whose main objective would be to reach a deal with the current coalition and with the Republicans to pass a budget. So that would be its main objective. But all in all, the political uncertainty has risen a lot, and that's something pretty striking if you look at our new index published by Bloomberg Economics that has skyrocketed over the past week. So it's really like a main trend in France that political uncertainty is really high, and we are facing a new political crisis. So as I said, our main scenario is for the government to collapse, President Macron to appoint a new prime minister. But our main risk is for President Macron to call snap elections. So that would be a really downside risk to the political situation in France, because it would lead to another fragmented parliament, and where probably the far right would have not a majority, but would be in a position to lead a new minority government.
John, at least when it comes to the markets, the main concern is that this political crisis could turn into a debt crisis and impact the bond market. What's your view on that?
So far, we are not really concerned regarding the bond market. In our view, it's mainly a political crisis, not a debt crisis yet, nor an economic crisis yet. If you look at the spread of French bonds against German bonds, it has widened by around 10 basis points over the past week, which is in a way pretty moderate, especially if you compare that widening to what happened last year with when Prime Minister Barnier was ousted by no confidence vote in December, when the spread widened a bit more. So in our view, the risks are contained. It doesn't mean that there is no fiscal risk in France. I mean, if you look at debt servicing costs for France, it will increase a lot in the coming years. And that's the reason why a substantial fiscal consolidation package is required for France. And that's exactly one of the reasons why the current government will fall, basically. It's to pass that important and ambitious consolidation package. So in few words, no specific fiscal risk on the short term, but some fiscal issues and major ones over the medium term.
How do you fit, Jean, how do you fit the French story, the debt challenges, of course, the deficit, 5.4% projected for this year, and what we've seen in terms of the OATs into the broader global context?
So absolutely, I mean, France is a massive issuer of long-term bonds, especially in the euro area. So that's one of the reasons why it is interesting to look at the sell-off on the 30-year point of the curve. So that's really important for France as well. But it's fair to say that recently the DMO has shifted its issuances toward shorter part of the curve, like the 10-year points, for example, so that there is no specific risk from that sell-off. I mean, at least from a fiscal perspective, there is no specific risk from that sell-off in the 30-year points. I mean, we can point out that it's also driven by global factors as well, like higher issuances globally, central banks doing QT, like some shifts in investors' preferences. If you think at Dutch pension funds, for example, that's pretty striking. but also to some global seasonality, to some global technical factors as well. So it's not only related to France, and it's not really like a fiscal issue for France, at least on the short term, because France is mainly focusing on issuing debt at shorter maturities like 10-year points. So it's not a big issue for the moment. It could become an issue on the financial stability, from a financial stability perspective.
Okay, Jean Dalbal, economist at Bloomberg Economics, thank you very much indeed. European markets, they've been pretty choppy so far in the session, 55 minutes into your Friday session, currently up 0.4%, as we, of course, look ahead to the big data print of the week, which is non-farm payrolls, expected 75,000, 4.3% potentially on unemployment.
Yeah, and attention on the revisions. You know, last time there was such a steep downward revisions on this payroll number. I thought it was interesting that our previous guest, Freya from TS Lombard, was talking about a run rate of 60K. That it being it for the U.S. economy if these deportations, if this immigration policy stays as strict as it has been earlier.
So should the Fed be cutting if we've got a 60K print?
I mean, in that mind, that's a hot print today, right? I think this is what the market's going to have to deal with. What is the bar for a hot print if the run rate for the U.S. economy, those estimates for what that break-even rate is all over the place?
It makes it really hard to call. And it certainly makes it harder for a 50. If the run rate is 60, to get a 50 basis point cut, do you have to have a negative print?
Negative, yeah, decently.
And this is a Freya Beamish who expects to see a tighter labour market in the second half and into 2026, and possibly higher wages as well.
I would argue that the NFP print is like a sporting event.
I like that segue.
I think
traders.
That's how we should be thinking about this. But you've got the NFL.
Yeah.
Second game.
Alcaraz and Djokovic.
That's coming up
shortly
over
after
the
non-farm payrolls.
Yeah, isn't Travis Kelce going down
Taylor
to
Swift's fiance in Brazil?
In Brazil.
Do you think she'll be there?
I don't know. the Italian Grand Prix is coming up this weekend.
Guy's still halfway through that podcast.
Well, precisely, yeah. Still enjoying it. New York Fashion Week. New York Fashion Week as well coming up. Plus also the tennis in New York as well. What a weekend in New York. Anyway, great weekend coming up. NFPs are first. We'll see you Monday. The Pulse is next. This is Bloomberg.